Hi everyone. My name is Shamyl Malik. I work for Voltaire Capital. We're a non-banking financial corporation, so a million miles away from a large investment bank, but still we're big in our own small way. We operate in capital markets across both sides of the proverbial pond, and we like to think we are light, efficient, and fast. We deal in risk transfer and liquidity provision to our clients. I'm going to try and keep this short and simple for my own good. So big data is clearly important. It's important for capital markets, and it's important for all the players in the capital markets. So we can start by defining who these players are. They come in all shapes and sizes, literally. There's some extremely large players in the market, some small. You have people who are called the Hound of Hounslow, just outside of London. He's just a 19-year-old kid operating outside from his parents' garage with not enough capital, but still affecting the capital markets. You have large bank liquidity providers. You have leaner funds. You have non-banking corporations like us who are market makers. You've got regulators and you've got clients. So in this slide, the traders would be similar to prop shops, hedge funds, large organizations, or nimble ones. They interact in the market and have needs for data. The regulator is there to maintain market integrity and make sure that no markets are manipulated. The clients are the end users of that liquidity. So before I continue, I'll have to apologize. Each slide that I have either has a cheesy picture on it or an extremely cheesy picture. So please forgive me and sort of bear with me on that. So the regulator, just to define a bit more about the regulator. So these guys can vary from sort of compliance departments at large investment banks to the mighty CFTC, the equally mighty, maybe slightly less mighty FCA, or your chief risk officer. Their job is fairly simple, either to regulate the market at a macro level or to regulate trader behavior at a micro level. Clients historically have sort of faced a more opaque relationship with liquidity provision. Whether it's dealing with a large financial institution or a small one, they always felt like there was something happening behind closed doors. Big data allows you to answer some of those questions, maybe not answer all of it, but at least gives a step in the right direction in terms of providing that transparency. We can talk about all of those things as we go along. Again, so you probably heard this before. You've got good data, bad data, and not so bad data. For all the stakeholders in the market that we've described, data is key. It's a central asset, and because it's a central asset, like any other asset, everyone wants to start accumulating that asset. And they start accumulating that asset on the back of new technology development, and they have the ability to store that asset and then utilize that asset. You know, some guys would want clean data, other guys want raw data and want the ability to groom that data themselves and then use it. And because they're so close to the data, because they've groomed it themselves, they think that adds the most amount of value. Other players in the market want fast data. They want real-time updates. They're very latency driven. So they would want as quickly, as much data as possible. And these things are becoming more and more possible as we go. And over the last 2 days, we've sort of learned how that data is being used and how quickly people are getting into the habit of assuming that terabytes and terabytes of data is available at every step of the way. So like I said, all the stakeholders want data, but it can vary over what time horizon they need the data. Large asset managers who are dealing with large scale executions might want data over days and seconds. Other people who are providing liquidity might want data over microseconds and milliseconds and sometimes nanoseconds. But what it all boils down to is how you analyze that data. And it depends on the analysis of the data, which results in what kind of decisions you can take on the back of that. So, so in terms of the analysis, you can either think about data to justify some of the results that you've already seen or preconceived notions, or actually to learn from that data to make new strategies. But it varies, and it all depends on what the stakeholders want. So if you look at the first stakeholder, which we discussed, let's talk about traders in general. In that entire space, what do the traders actually want to get from the market? They want to extract value. And any way you think about it, they want to extract value by looking at different scenarios that have happened, either in the past, 10 years, 20 years, 30 years, or in the more recent past, in the last 2 seconds, in the last 100 milliseconds, and so on. But essentially, it's all about looking at different scenarios and then identifying from those scenarios if you can identify anomalies and then either reject those anomalies or find a reason for those anomalies and make a decision on the back of those anomalies. Or in other instances, look for associations, whether they're positive associations or negative associations, and then you decide on the back of those associations. So here, the market's changed, and I've been in the market now just a little less than a decade and a half, so not 30 years or 25 years, so I'm fairly new in the market, but still have been fortunate enough to see a market which was not focused on electronification, not focused on big data, wider spreads across capital markets, and massive asymmetry of information, to a market now which is massively focused on electronification, extremely focused on big data, operates in extremely tighter spreads, and everyone wants to either reduce or eliminate asymmetry of information. So, so going back to the traders, if you think about medium and long-term analysis of data, what are they actually trying to figure out? What they're trying to figure out are correlations. Trying to figure out correlations and analyze trends to have an opinion about what would happen next. So people could think about, in the past you had a lot of value that was given to experience, human experience. So some guy would sit on a desk, and because he'd been sitting on that desk for the last 20 years, he would be able to say, I was there. I was there when and doing what? I was there when the central bank made this decision. And because I was there when the central bank made that decision, I know how the market reacted. I remember that the day crude oil fell $10. And as a result of crude oil falling $10, what happened to Aussie dollar? I was there when the S&P crashed. And when the S&P crashed, and because in that regime, euro dollar was very correlated to S&P, we can form an opinion about S&P. However, now, given that we've got data to the extent we've got data, we don't actually need human experience. We can actually get more pinpoint precision on events without having been there. So that's a big change in the sort of medium to long-term guys who are looking at trend analysis. So data has actually improved the ability to analyze, or technology has actually improved the ability to analyze that data. Now if you go further down into a time frame which is even shorter than the medium to long term, that's an area which is evolved and developed as a result of big data. And what I mean by that is that as data needs grew and people started getting more and more data and the ability to analyze that data, intraday data or daily returns data turned into tick data, and then tick data turned into microsecond precision data, and then it turned into nanosecond precision data. And everyone wanted to invest more money to get faster and faster technology to figure out how the order book, which is on the exchanges, so on how the order book interacted with orders, whether these orders were sent in an aggressive way, whether they were taking away liquidity, whether they were actually passively placed in making liquidity, how the order book changed after an event took place. So the guy was saying, I was there when the central bank made the decision, or when the news hit the wires. He only knew anecdotally or from experience, because he was sitting there, what happened to the market. But because of this data, we can actually figure out exactly what the order book looked like, whether it was better bid or better offered. Better bid meaning more bids on the left hand side, better offer meaning more offers in the market. How it looked before the event and how it looked immediately after the event. So you have more information because of data science and what we've been discussing in the last 2 days than the guy who's actually sitting on the desk. He only remembers that client A, who's a massive client, paid me in Eurodollar, or he only remembers that 10-year treasuries were better bid just before and then came in massively offered. So his evidence is more anecdotal and based on experience than actually what was happening in the market. So as I was trying to explain before, microstructure meaning high frequency data allows you to come up with predictions in the shortest space of time. So we had Professor Emmanuel yesterday, an interesting talk about Hawkes processes and how in a very short period of time you can have mean reversion. So if you look at it from a general perspective, in a very short space of time, markets do generally mean revert. In a slightly longer space in time, markets are more trending. But those two prior assumptions you want to be able to justify, and the way you justify that is by use of big data to improve your analysis, or by use of big data to create that analysis. So that's generally how one portion of the market is using that data. But within the sort of category of traders, there is another player in the market who are called market makers. So what they do is they create prices for their clients. They use the big data that we described to create a price that they can show to their clients. They're always concerned about creating a mid price in the market. So imagine the market is 9.11 on one exchange, it's 9.5, 10.5 in another exchange. They want to be able to commingle all of that data to create their own mid. They will add inventory skew behaviors to their mid to improve their mid. They will sometimes add alpha signals to improve their mid even more. They're generally passive in the market. So the guys we described before were more aggressive in the market, and they're liquidity takers in more instances. These guys will always talk about themselves as liquidity providers and makers of prices, and generally being passive on the bid and passive on the offer. And their main goal by using this big data, apart from creating the price, is to prevent them from what they like to call being picked off. Because sometimes the clients that they're dealing with are faster than they are or smarter than they are. And in some cases, both smarter and faster. So they want to just make sure that they are providing liquidity by just, or making money by just staying on both sides of the market at all times, and making sure that the mean reverting nature of the market allows them to stay on both sides of the market and make what in trading they would like to call bid ask at all times. After they've been traded by use of these technologies, whether it's KDB or whether it's R or MATLAB, they will be able to figure out what client behaviors they like and what client behaviors they don't like. They will look at good flow and bad flow. They will improve their pricing for the people they think is good flow. They will make their pricing worse for guys who they think give you bad flow. And these are not, these are things that are being talked about at various levels across all the trading community, whether it's large bank, liquidity providers, small market makers, exchange players, brokers, interdealer brokers. All of the people that we talk about are dealing with these two issues in some way, shape, or form. So that sort of allows us to move into. Oh, I'm really sorry about that slide. So the guys who deal with liquidity providers are your clients. Clients historically, as we discussed before, are the guys who think that big data comes to their rescue. Because what would happen is that you had in So people who are not familiar with the capital markets, and I hope there are few who are not familiar, what will happen is the client will ask, a marketer or a salesperson for a price. The salesperson will go to his trader for that price. Now, the client is far removed from what is happening on the screen. So you will have the ability for the guy to ask for a price, which would be a two-way price, but they could potentially, I've never seen this, I've only heard about this, a salesperson could gesture to the trader that I'm looking for your two-way, or I'm looking for your two-way. And if you're looking for a two-way, where the gesture is that you're looking for a two-way and the client is most likely a buyer, you would skew your price through, in a way, so if the market is 9.11 and you wanted to show a 12 offer, which would be a more neutral offer, you would show a market which was 15.18. So the client would end up paying 18. So he's been shown a price, but that price is far removed from reality. And then on top of that, in some instances, you might have a markup on that. This is mostly true for OTC markets, whether it's fixed income or FX. In equities, which is a more exchange-based market, things are somewhat different. But clients got used to the idea and started focusing on how they could reduce that extra cost. And big data allows them to do that because they can ask their counterparties to provide them with execution algos. These execution algos come about on the back of using big data. So you can actually think about market microstructure, you can think about how you put your order out there, because clients are now focused more and more on slippage. Slippage being, if the market is 9.10 when the order comes in and you want to buy 300 million, say, euro-dollar, and the human trader pays the 11 offer, 13 offer, 15 offer very quickly, the chances are that most of the order is going to get done at an average of 14.5. However, if you used implementation shortfall, TWAP, VWAP, some other kind of algo for people who are familiar with these things, you could reduce. So you could do two things. One, reduce the slippage. You could reduce also your market impact as a result. But more importantly, for large asset managers, sometimes you could justify to your investor why you've used what you've used, which is an algo. That happily brings us to another point, which is transaction cost analysis and pre-trade transaction cost analysis. In the same way of that justification of why you used a particular algo, people started looking at transaction cost analysis and whether it was a good time to actually execute dollar MEX when the US market is closed. Because you will obviously pay a bigger spread because there is more asymmetric information at the time in the market. So it would make more sense to have the algo look at what the liquidity in the market was, what the volatility in the market was, and make a decision on the back of that. And people who've been in the market, I think, will be familiar with the last point. There's a lot of human intervention which took place for market makers. So a trader at a bank or a non-bank who had lost money would generally do a bad execution for their client. And the reason why they would do a bad execution is because they would like to get as much money or buffer from the money they lost on their position. So generally, there was a massive gap between execution quality depending on human trader emotion. Machines and execution algos give clients more control, more transparency, and also gets them away from this sort of emotional roller coaster of the trader in question. So then, after we've discussed clients, what we could do is move on to regulators. So, I promise this is the last of the cheesy pictures. But there's been more and more emphasis on trader behavior, on financial institution behavior. There's been a lot of emphasis on what traders were doing before. I'm sure you've read about collusion in the trading behavior. So the regulator needs to be equipped with all the data that they can get their hands on, whether it's pre-trade data or post-trade data, whether it's archive data or what happened 3 years ago or 4 years ago. They should be able to figure out what happened at various events to be able to penalize institutions that were misusing or abusing the data and the client's trust. Recently, I'm not sure if you guys followed, but even in the market making space, we can talk about spoofing. So spoofing was generally an idea that was used by traders all the time in the past, whether it was voice traders, and then it sort of got it started being used in electronic markets also. But spoofing was when a trader was actually a seller of an asset, but would actually prop up the market by showing bigger bids just below the top of book. So imagine the market is 9.10 and he wants to sell at 12. What he would do is start flashing big bids at 8, 7, 6. And so people who are looking at liquidity imbalance indicators to move their price or predict the next tick would start trading the market higher. So anyone who was short at the time would start lifting the offer and the market would start trading up. And again, I've actually never firsthand seen this, but I've only heard about these things. And then he would actually be able to fill his offer at 12 or 13. Obviously, this was something which the regulator was quite unhappy about when they actually figured out, because this is now illegal. But the regulator needed to have an appreciation of big data, because if you're trying to catch anyone, who's on a fast car, you can't do it on a bicycle. So you have to give the right tools to the referee so that he can actually deal with all parties involved and sort of, trying not to use a over cliched word, but level the playing field. And overall, the market required protection from, protection in terms of analyzing stress and market dynamics. And with the evolution of technology, you can have real-time stress indicators which can curb market moves and so on. So that's how data is useful for the regulator and how they want to do surveillance on market activity. So while I go to my conclusion, I think it's important to mention here that I can't stress this enough, in my opinion, over the evolution of the market, the main thing which is getting more and more focus is the leveling of the playing field in terms of reduction in asymmetry of information. And this is asymmetry of information within the three categories that we discussed before and across those categories. So there's a lot of asymmetry of information between traders and clients. The regulator doesn't want that, so the regulator wants to reduce that asymmetry of information. There was a lot of asymmetry of information between large liquidity providers, large bank liquidity providers, and their clients. There was a lot of asymmetry of information between large bank liquidity providers and small market making firms, because they were focused on technology and they were more nimble and actually able to figure out what was actually happening at the microstructure level. So this asymmetry of information is being reduced more and more day by day because of the focus on big data. And obviously big data serves all the players. What are your challenges for big data? And obviously this is something which has been talked about a lot before. It's infrastructure. Costs vary massively. You have some large firms with equipment worth hundreds of millions, others worth tens of millions, some less than that. So it depends on what your niche in the market is and what equipment you actually require. And obviously people, we've heard that people who do data science are not easy to find. I would like to take a bit of a contrarian approach to that, because it was suggested yesterday that they're very difficult to find, but at the same time, people with a broad-based technical undergraduate degree and a good MBA are good proxies. So, if I look at India, people who go to IIT and IIM, and you have entire cities of people who have the skill set that is described in the data scientist presentation. So I'm not sure if it's rare. I think the skill set is there, they've just not been told that they're actually data scientists. So if they were groomed in that way, maybe that solves some of the problem. And that's that. Thank you very much for listening.